Happy weekend, investors! JPMorgan Chase, the king of Wall Street, just dropped its earnings report, and it's packed with crucial insights. This report didn't just beat expectations, it gave us the clearest answer yet to the big question. Is the US economy headed for a crash? Many are worried about their retirement funds or their investment portfolios in these uncertain times. JPM is making money hand over fist, showcasing remarkable financial strength and resilience. However, they're also issuing a critical warning about credit card debt, a signal that demands our immediate attention. Why do we care so much about JPM? It's not just any bank, it's the veritable plumber of the entire US economy. JPM connects millions of consumers, supports countless small businesses, and facilitates transactions for the top trading rooms on Wall Street. Looking at their earnings is like getting an X-ray of the American economy, revealing its true health and underlying dynamics. This time, the report card is straight up an A+. Their diversified business model truly highlights resilience amid changing economic conditions. Earnings per share, or EPS, smashed expectations at $5.07, easily surpassing the $4.84 consensus. Total revenue hit an impressive $47.1 billion, marking a 9% increase year over year, while net income rose 12% to $14.39 billion. How did they achieve such stellar results? The answer lies in two incredibly bright spots: record high trading revenue and solid net interest income. Trading revenue soared an astounding 25% year over year, indicating a significant surge in market activity. This tells us that the market's blood pressure is spiking, with clients actively hedging and repositioning their assets. Such intense activity translated into massive trading commissions for JPM, fueling their revenue growth. Even better, the investment banking business is making a strong comeback, with IB fees growing by 16%. This is a super important signal. IPOs and M&A activities are recovering, showing renewed confidence in the future. Companies are now willing to pay JPM big bucks to make deals happen, reflecting optimism in economic prospects. Next up is the banking industry's lifeline, net interest income, or NII. In a high-rate environment, everyone worried NII would start to shrink, but JPM proved its resilience again. Their NII remained strong, and they even raised their NII guidance for 2026, projecting a huge pie of $95 billion. So the first impression is clear: Wall Street is crushing it, and corporate confidence is up. But does this mean everything is perfect? Nope, not quite yet, as there's a crucial warning to consider. Now let's talk about the most crucial warning from the conference call, the one that directly relates to your everyday wallet. JPM set aside $3.4 billion in provision for credit losses, which is higher than the market expected. Why did they do this? Because they see that the default risk on unsecured loans like credit cards is normalizing. In plain English, more people are starting to struggle to pay their debts, a trend that bears close watching. Even though CEO Jamie Dimon said the US consumer is overall healthy with jobs and savings, JPM still raised their expected credit card net charge-off rate for 2026. Folks, this isn't a call for an immediate recession, but it is a red light. High interest rates are starting to put pressure on the most financially vulnerable households. If you have a lot of credit card debt, pay attention to this trend. The bank is protecting itself, and so should you. So, what does this report actually mean for us, the stock market investors? I have three key investment takeaways for you. First, a strong case for an economic soft landing. JPM's stability and optimistic NII outlook are some of the best pieces of evidence for this scenario. It tells us the economy is not crashing. The core activity is holding up, which is a net positive for the overall market, especially cyclical stocks. Second, the superiority of megabanks. The strong performance of large, diversified financial institutions like JPM shows their resilience in a changing environment. When NII comes under pressure, they can rely on investment banking and trading to fill the gap, supporting the valuation of large, diversified financial stocks. Third, a catalyst for cyclical and growth stocks. The rebound in investment banking and M&A often signals rising risk appetite in the market. Money may be shifting from defensive stocks back into higher growth, more cyclical stocks and potentially tech stocks. This is a good time to review your portfolio allocation and ensure it aligns with these emerging trends. All right, team, that's the JPM earnings deep dive for today. Remember, the big boss on Wall Street has told us two key things. Market momentum is back, indicating a robust financial environment, but underlying credit stress is building, a point of caution for consumers. Your action list is simple. If you're a financial stock investor, JPM proves the value of the sector leader. If you're a regular consumer, heed the credit card warning and manage your debt wisely. Do you think JPM's optimistic NII guidance is achievable? And what do you make of their increased credit loss provisions? Let me know your thoughts in the comments below. Stay invested, stay smart,